dollar still weaker. Our Steve Leisman joins us now from Washington with some of the highlights. Steve, what was your takeaway?
Minutes to the Fed's December meeting released this afternoon showing Fed officials just about as hawkish as the Fed chairman, Jay Powell, was in his press conference following the meeting. The minutes said no member thought it would be appropriate to cut rates in 2023, directly contradicting expectations in the market for rate cuts this year, and that every member raised the expected path of the funds rate in their projections this year in December compared to their projections in September. For a taste of how the hawks ruled the December meeting, and there weren't really many doves present at all, the minutes said there was a restrictive stance was needed until they were confident inflation was heading towards target. Several said history warned against prematurely loosening policy. And while the risk of tightening too much was acknowledged by many, the risk of tightening too little was clearly seen as the bigger concern. You can see how much concern there was by looking at the Fed's forecast for rates above 5%. That's 17 of 19 Fed officials. And yet a forecast for the 2023 growth to be a year well below trend, according to the minutes. Finally, the Fed is clearly watching market levels. Yields had fallen in the lead up to the meeting, and the minutes said officials warned against a premature easing in financial conditions. Some of those financial conditions have bounced back, but they remain looser than they had been. Back to you.
So, Steve, is this the clearest sign yet that the Fed is getting worried that the stock market has rallied too much, that the dollar has weakened too much away from their goals of tightening to get rid of inflation?
Sarah, I'd have to check to be sure, but this was certainly one of the more stark mentions of concern about the easing of financial conditions. You remember what happened in the summer of 21 when financial conditions eased, and that kind of led the Fed right back to the 75 basis point rate hikes that it was doing, and really to clamp down on financial conditions and essentially target them. What happened, if you want to judge it, I don't have a chart with me, Sarah, I'm sorry, but if you look at the Goldman Sachs Financial Conditions Index, it fell by about 2 points leading up to that meeting, and it's gathered back about a point of it, which tries to include all of the different aspects out there, like the stock market and bond yields. But you're right to point that out as a major concern of the Federal Reserve. They need rates high to keep growth low and to loosen up the job market to get rid of that threat of inflation they feel is out there.
It's especially problematic, I would think, when the loosening of financial conditions speaks to the market expecting cuts when the Fed is saying we're not cutting in 2023. So a little bit on different pages on both of those sides.
They went right at that, Sarah, in a way that I had not seen in the past. They said no Fed member has forecast cuts in 2023. They didn't have to say that because you can see that by looking at the SEP. But they made a point of saying exactly that, trying to get right at the market's expectations for cuts.